All right, we're going to finish the last part of Chapter 9. Let's just briefly talk a little bit about mutual funds. As I've mentioned a little bit earlier, there's a whole chapter where we're going to spend a lot of time talking about mutual funds. Essentially, what I think we need to know from mutual funds is that there's a lot of information out there, and you really have to be careful about where you're getting your information from. When you are issuing or when you're buying and selling mutual funds are not bought and sold like stocks and bonds are. They are a buy and hold strategy. By definition, they are a long-term investment. So the actual sale or redemption of mutual funds should be taken very, very seriously. It reflects a major change in investment strategy. Possibly if the mutual fund changed its investment objective, if for some reason it started performing poorly. I mean, those things obviously make a little bit of sense. But in general, the sale of a mutual fund, we shouldn't be redeeming them all that often. How taxes are ultimately paid are certainly obviously based on the distributions. Mutual funds can distribute interest and or dividends on a monthly, quarterly, semi-annually, or an annual basis. They can only distribute capital gains on an annual basis. So how you decide to reinvest or not reinvest really doesn't matter all that much. The idea is that in the end, there are going to be taxes paid on the income that's earned. When you sell a mutual fund, though, it gets a little bit trickier. How do you determine what the base cost is? What's the basis for tax calculation? And you can do it by specific identification, pick specific funds and use those to offset any profits that are made. The challenge is that requires a lot of paperwork. The first in, first out method is fairly easy since you have a record from your mutual fund company of all the shares that you've purchased. You can easily identify which shares you want to in the very beginning and keep a running total, and of course eliminate those and note that they've been sold as time goes on. The average cost method is, quite frankly, a little bit easier, right? You know on average how much you've spent to buy the funds, divide that by the number of shares you have, and that's the approximate cost to purchase. So it requires a little bit of thought, but not terrible amount of bookkeeping. The last half of this chapter then really is a reflection of some portfolio construction, some theory about investing, and I must tell you that there are entire courses that are taught on portfolio management and risk diversification. So this is going to be very quick, very dirty. We're just going to try to get some basic concepts across. The basic idea of creating portfolios, the thought process that you should have, is that you must be always thinking about diversifying your holdings, that is, spreading out your investments. And you must then also be thinking about what asset classes should you own. The concept of an efficient portfolio means that the creation or the portfolio that you created is going to earn a certain amount of return. So the expected return is obviously a calculation. It's the weighted average. Now, when the assets are not perfectly correlated with each other, that is, if they're not exactly alike, then when we combine them, we will get some diversification. We'll actually see a picture in a little while that talks about this efficient portfolio or illustrates it. But the idea here is that when you're diversifying a portfolio, you're reducing the overall risk of the portfolio while at the same time trying to, at the very least, not reduce the returns of the portfolio. And this is the essence, as it says here, of modern portfolio theory, of trying to understand how assets work when they are in portfolios. The theory that drives this is something referred to as the capital asset pricing model. Again, investors that expect to beat the stock market without assuming any risk really are kind of fooling themselves, right? They have to generate a return that's going to get a higher rate of return than the portfolio or the market itself. So in other words, if you want to beat the stock market, you have to take higher risks. If an investor assumes higher levels of risk than the risk of any efficient portfolio, that is one that's going to be maximizing these returns, then of course they're going to, again, be expecting or realizing some compensation for that. So again, these are really paragraphs are kind of describing the same things, because in the end, an efficient portfolio maximizes returns while trying to minimize risk, or it minimizes risk while trying to at least maintain returns. So again, if portfolios are earning certain returns, then we need to also then expect a certain amount of risk associated with those returns. The concept of diversification, again, as I mentioned, is the idea or the concept of spreading out investments. You can domestically diversify, and of course you can globally diversify. One of the challenges with doing this individually is the information that you need to research. Again, just to get back on my soapbox a little bit, in the mutual fund world, unless a mutual fund specifically identifies itself as a United States equity mutual fund, it will probably have 5 or 6% of its investments will be international. So almost any equity mutual fund will have some global diversification. If you want to increase that diversification, then you have to look for specific mutual funds, identify them as international mutual funds that only invest in the funds of companies or the securities of companies from outside the United States. Coming back to our efficient frontier idea again. The idea of this is that each portfolio that is labeled as efficient is going to offer the highest expected return given its class of risk or its risk class. Let's think about, I want to go down here and look at a picture. And here's in general a picture of portfolios. And I just want to skip ahead here to kind of just talk a little bit about what we're talking about as far as the efficient frontier. You can either invest in stock, this asset A, or you can invest in an asset directly above it. Well, which one would you rather have? If we assume that they both have identical risk, then the portfolio up here, let's call it G, because it's right in the middle here, has a higher return and the same amount of risk. So G is a better investment than A. Likewise, anything on the bottom side of this curve has something better up here. So this upper part of the curve is what's referred to as the efficient frontier. It identifies all those investments that have the highest possible return and the least amount of risk possible for that level of return. So asset allocation then is the process of spreading assets out. It really looks a lot like diversification, but instead of looking at individual companies and securities, what we're doing here with asset allocation is you're looking at asset classes. The three primary asset classes are stocks, bonds, and money market securities. So if you can imagine a piece of pie that has components that are stocks, bonds, and money market, asset allocation is the process for trying to figure out what percentage of the pie should be stocks, bonds, and then of course money market securities. Since we know that risk and reward are positively related, you would want to hold a portfolio that's diversified amongst the three asset classes that identify or match up with your particular desired level of risk. We already talked about this and how you can see that certain combinations will reduce the risk, and then ultimately we can have increases in returns based on the combination of stocks and bonds. So this is a graph of an asset allocation between stocks and bonds and the returns that you could earn. So what are the steps in asset allocation? First, you have to figure out what the type of portfolio is that is going to match your risk tolerance. We need to analyze prevailing market and financial conditions, and we're going to select the types of products that we want from each class. Finally, in step 4, it's a lot easier to just do this with mutual funds, but then we need to select the mutual funds and the individual securities that match those weights from the above steps. From time to time, we need to rebalance the strategy. We'll actually have an example of this in a later chapter where I show you a portfolio that I created and we can look at how it's changed over time and what rebalancing does to the market itself. But essentially it says over time some things are going to earn money and some things are not going to earn as much. We want to maintain our risk tolerance. So we want to maintain the combination of that pie, if you will. Again, let's say we invested in 50% stocks and 50% bonds. In the normal scheme of things, stocks make more money. So after 2, 3, 4 years, maybe we're at 75% stocks and 25% bonds. Again, that doesn't match our risk tolerance that was 50-50. So we have to rebalance. That is, we have to sell some of the things that have made money. If you remember the golden rule, that's what you want to do. Sell things that have made profit, and then buy those things that have not performed quite as well. How can we look at mutual funds? And then this is just kind of a prelude to getting to a mutual fund chapter. But how can you figure out which mutual fund is the best to buy? Well, the first thing you need to do is you need to select a mutual fund family. And the service of switching funds and breakpoints makes the use of one family the best option. It's cheaper, it's more convenient, it's tax effective to have one mutual fund family rather than several. So it doesn't really matter which mutual fund family you pick. The larger ones all have mutual funds. Each one's going to have some good and bad funds. And the greater the number to choose from, the less likely you ultimately might be forced to invest in a poorer performer. In a 401k, this strategy isn't quite as important because you'll have a mix of fund families. And of course, since it's in a tax-deferred vehicle, it really doesn't matter that you switch back and forth between mutual funds. Again, this really isn't a scientific approach, but it does start by identifying those characteristics that are most important for return generation. So what we want to do then is classify the mutual funds, families funds by basic categories. Most mutual funds do this for us. They'll identify or categorize their funds. If you look at the mutual fund family website, they typically will give you the classification. And for instance, they'll say with respect to the growth funds, these are what we call growth funds. Next, you need to gather the information that you think is important for mutual fund performance. So what I would do is first, filter the group by life as a fund. And I would eliminate all mutual funds that really had an inception date that was sooner than 3 years. You really want a mutual fund that's been around for a while. And after that, you need to create a checklist to rank the funds. Now here is a basic Excel spreadsheet that you can get this information from almost any of the publications that you can think of. Morningstar is probably the easiest and the best one to get to. But as you can see here, we have a variety of variables that we can look for, right? We can look under the quote page is where you'll find this data. Under the ratings page, this is where you'll find that data. Under the portfolio management, that's where you're going to find this data. And then we see here I have 3 funds. So what I would do, and this is a spreadsheet that's available to you, what I would do is I would just rank these 1, 2, 3. Which one has the highest yield, the lowest yield? So these would be 1, 2, 3. And then over here I'd have 3, 1, 2. Then 1, 3, 2, 1, 2, 3, 2, 1, 1. And then when you're done, you add all of those across, and you'll find that one that has the number 1, the one that was the number 1 category the most, will have the lowest number. And again, this is not strategic. This is not scientific. There really are no real scientifically proven techniques to identify and prove which mutual funds are best. So we need to create something that's going to give us a feel. And again, these are all mutual funds from the same fund family. So for instance, if we wanted to put, if this was the growth fund category, and they had 3 mutual funds that were growth funds, and when we were all done this, we wanted to put 25% of our money in a growth fund. So we get to the end and we find out that fund 1 and 3 are equal. Well, they're equal. So let's put half of that in each of them. There's nothing says we can't put all of our money in all of these, but it does make sense that some may perform better, some may look better than other funds. So again, this is just a very simple way of trying to quantify something that really there are no direct tools to do. I'll see you in the next chapter.